Why do I invest in real estate? The answer is found in one word, and that word is control. Investing in a defined contribution plan gives me a greater sense of control over my finances. With this kind of plan, I decide how much money goes in, and I have more control over where that money goes. Additionally, I have the potential to earn more money from my investments than I could with a traditional savings account or other investment vehicles, giving me more control over my financial future. With this type of plan, I can feel confident that my money is being handled responsibly, and that I have greater control over my investments and my life. Always remember the following. People worry about job security because they lack control over their job. Few employees have any control over the ownership of the company, how much they earn, how much they are taxed, or the future of their job. In addition to control, real estate offers many other advantages. If a piece of real estate is purchased at the right price, is financed well, is in a good area, and is well managed, then some of the advantages of real estate are the following. 1. Cash flow. Checks come in every month. 2. Leverage. Bankers will line up to lend you money for investing in property. Ask your banker if he or she will lend you money to buy mutual funds. 3. Amortization. Tenants pay off the debt. 4. Depreciation. The government offers tax breaks for real estate because it goes down in value. Real estate can go down in value, but it tends not to. In reality, the reason why governments offer depreciation incentives is because real estate investors provide housing. 5. Creativity. The value of the property improves through creativity. For example, if I buy a piece of raw land, I can change the zoning, or I can buy an old house and fix it up, or I can convert an apartment house to condominiums. 6. Expandability. Once I learned how to buy single-family homes, I expanded into multiple units. Today, when my wife and I buy a property, it needs to be at least 250 units. 7. Predictability. After purchasing an apartment complex, it typically takes about a year for it to become fully stabilized. During this time, management can make the necessary repairs and improvements to attract quality tenants and raise the rent accordingly. After a year, the building is generally running like clockwork, with the added benefit of reliability, monthly checks in the mail that don't fluctuate with the stock market. This provides a greater sense of security and control over one's finances than investing in the stock market, where prices can go up and down unpredictably. Good real estate management is essential for success in the industry. Many stock, bond, and mutual fund investors may be wary of investing in real estate due to the management aspect. But with the right approach, it can be a lucrative and rewarding endeavor. Kim and I chose to invest in apartment buildings with more than 100 units because we had the resources to hire professional, experienced managers to take care of the day-to-day operations. Additionally, some of the best investment opportunities can come from buying properties that were previously owned by poor managers. With the right management, these buildings can be turned around and become highly profitable investments. 8. Tax-deferred money. One of the major benefits of investing in real estate is the ability to take advantage of tax-deferred money. Through the 1031 tax-deferred exchange, real estate investors can legally avoid paying taxes on some of their profits. Last year, Kim and I sold a small apartment house and made over $1 million in capital gains, yet we were still able to reinvest that money without having to pay taxes. This tax-deferred treatment is not available to those who invest in stocks, bonds, and mutual funds, making real estate investing a much more attractive option for those looking to maximize their wealth. With tax-deferred money, it's possible to accumulate wealth faster than ever before. 9. Appreciation. Because the dollar is going down in value, real estate tends to increase in value. Also, as our population increases, demand increases, which also drives up prices. Most investors invest for appreciation, capital gains. In the stock market, most people invest low hoping to sell high. This is investing for capital gains. In real estate, these investors are known as flippers. Flippers also buy low and hope to sell high. The problem with a capital gains strategy is that the strategy generally only works in an uptrending market. If the market trends down, as known as a bear market, many paper asset investors and flippers are toast. Investing for cash flow is better than investing for capital gains in real estate because the tax laws favor the cash flow investor. Why appreciation is last. For most people, appreciation is often the first thought when considering buying a property. However, there are other important aspects of real estate investment that should not be overlooked. Flipping a house can be a lucrative option for some, however, it requires a lot of hard work and comes with a high tax rate. My preferred strategy is to purchase multiple properties over time and benefit from the other 5 reasons for investing in real estate, such as cash flow, tax benefits, leverage, equity, and building wealth. This strategy allows for steady growth and can provide long-term financial stability. Investing for the long term can be a profitable strategy as it can result in less work, higher income, and lower taxes. I prefer to focus on the 5 main reasons for real estate investment, such as cash flow, leveraging, tax benefits, building equity, and wealth building, instead of relying too heavily on appreciation. Speculating or gambling on appreciation is not a sound investment strategy and can be particularly devastating when the real estate market crashes, which can and does happen on a regular basis. The secret reason. I appreciate the slow pace of real estate investment, which makes it a great choice for people like myself who are part of the baby boom generation, the last of the industrial age and first of the information age. I am not very tech savvy and do not have or want an email address, but I still benefit from the internet through my company's websites, which have earned me millions of dollars. Real estate is a reliable and safe option that allows me to stay comfortable in my current situation while still gaining a financial return. When I bought my first computer, I used it mainly as a typewriter and word processor, but was unable to take full advantage of its capabilities. As technology advances, I am becoming rapidly more obsolete and can no longer keep up with the new changes. I tried using an iPod, but could not figure out how to put information into it or how to get anything out of it. This was a turning point for me, and I realized that I was not a techie. The moment I knew I was obsolete was when I attempted to program my VCR in the 1980s. From then on, I knew I was not equipped to keep up with the rapid changes in technology. When it comes to investing, I prioritize real estate over trying to keep up with new technologies. After all, everyone needs a place to live and work, and with a growing population and declining value of the dollar, real estate is a sound investment as long as I buy the right properties, in great locations, at the right price, with good financing and management. Although technology is constantly changing and evolving, the real challenge is staying relevant and up to date. The young people born after the year 2000 will radically accelerate the rate of change of technology by the year 2015. Just as high school kids of my generation began building souped-up cars, the kids today will take today's technology and soup it up. The web has only been around since 1989. Kids born after the year 2000 will experience a completely different reality than I do. They no longer watch television or read the newspapers. They do not know what world borders are. They know they can do business online and globally. When I was in elementary school, television first became available in our homes. By the 1960s, riots were erupting in the streets. The reason for this was because television had brought the Vietnam War into our living rooms, a true and unedited account, unlike the romanticized version of war that was portrayed by John Wayne or Hollywood. My generation was exposed to the harsh realities of war, the bodies of women and children being torn apart. That is why my generation rioted, at least some of them did. It will not be long until this new generation makes their presence felt. They may ask tough questions like, why are we not seeking alternative energy resources? Or why not LBCUS on reducing global warming? Or why is there poverty? Or why are there different tax laws for different people? Or why don't we teach kids about money in school? Hopefully they will rake on the challenges my generation has swept under the carpet. People with vision master the ability to see through to the heart of issues and investments. They value transparency. Many of the blue-chip companies that millions of investors have their money invested in may not remain blue-chip companies for much longer. These companies are likely to be replaced by new companies, run by young and innovative minds, that will bring them down. Just like GM was the powerhouse of the business world when I was a kid, but is now a giant struggling to keep up with the times, the Microsofts, Dells, and Googles of today could be the GMs of tomorrow. When it comes to real estate, I don't care who the tenant is, whether it's GM, Google, an older baby boomer, or a new kid on the block, as long as the rent is paid on time. This is the real reason why I like real estate. No matter how quickly technology and the world changes, real estate can remain relatively unaffected and take a very long time to become obsolete. Who owns your real estate? Just as a side note, I thought you might be interested in who really owns real estate. The term real estate comes from the Spanish word real, which means royal. So real estate literally translates into royal estate. That is because during the agrarian age, there really were only two classes of people, royalty and peasants. As mentioned earlier, the royals owned the land, and the peasants lived on and worked the land. As payment for living on royal land, the peasants paid a tax in the form of a percentage of their crops to the royals. Today, we still do own out zeal mime. The government owns our land. We all pay a tax, known as property tax, to the government. If we do not pay this tax, we soon find out who really does own the land. As you can tell, not much has changed. How many ways do you get rich? Warren Buffett is famous for talking about the intrinsic value of a stock. While many people parrot or mimic Mr. Buffett's words on intrinsic value, very few people know what he really means. In this article, I will do my best to explain intrinsic value as simply as possible. If you would like a more sophisticated explanation, then you may want to read the plethora of books written about him and his methods of investing. Once you understand intrinsic value, you may better understand why some investors make much more money than others. You will also realize that you can find intrinsic value in investments other than stocks. I will explain intrinsic value using real estate as an example. Why do I use real estate? Because real estate is more tangible than stock, meaning more people will be able to understand intrinsic value. When the average investor thinks about making money, he or she usually thinks about buying low and selling high. For example, an investor buys a stock for $10 and sells when and if it reaches $20. He gets up every day and checks the stock price. Many investors are addicted to watching the market go up and down. Their day gets off to a good start if the price goes up and to a bad start if the price goes down. That is not what Warren Buffett does, and neither do. While the price of an asset is important, it is not something we watch on a daily basis, as many investors do. Warren Buffett pays close attention to price when he buys a business. After that, he really is not concerned if the share price is going up or down, nor does he care if the stock market is opened or closed. He does not play the stock market, as most investors do. First of all, Warren Buffett does not just own stocks. He owns businesses. Secondly, in very simple terms, what Mr. Buffett looks for in a business is a well-managed business that will grow more valuable over time. He often refers to business value compounding, in other words, accelerating in value. Shifting to real estate. Let's shift to using real estate as an example, because I believe it may be easier to explain intrinsic value from a real estate perspective. When I buy a piece of real estate, I am only concerned about price at the time of purchase, the same as Mr. Buffett, because price determines returns. What I am looking for when I purchase a property are the following 4 streams of income or cash flow. 1. Income or cash flow. This is hopefully called positive cash flow after all expenses are paid, including my mortgage payment and taxes. 2. Depreciation or phantom cash flow. Depreciation appears as an expense when it really is income that comes from a tax break. This confuses many people who are new to investing in real estate. It is cash flow or income you do not see. 3. Amortization. This is income to you because your tenant is paying down your loan. When you pay the mortgage on your personal residence, this is not income to you but an expense. When your tenant pays your loan down, it is cash flow. 4. Appreciation. This is really inflation that appears as appreciation. If your rental income goes up, you as an investor can refinance and borrow your appreciation out as tax-free cash and have your tenant pay for the amortization of the new loan amount. In other words, it could be tax-free cash flow. As a real estate investor, I look for investments that offer intrinsic value, such as increased value and cash flows. I'm not interested in speculating or buying property for the purpose of flipping it for a quick profit, as this often results in capital gains that are taxed at a higher rate. My focus is on investments that provide a steady cash flow and increase in value over time. Warren Buffett has also expressed a preference for investments that compound returns, rather than those that result in a tax liability from selling shares. Therefore, I invest with a long-term view, expecting cash flow and increased value in the future. The power of vision. Financial literacy helps an individual to understand the financial implications of their decisions in a way that the average person may not be able to. This ability to think critically and understand the potential outcomes of a decision is what I refer to as vision. Donald and I invest in real estate because we can assess the potential for cash flow and the overall value of the property. People with vision are able to recognize the potential of an investment or issue and identify potential pitfalls. They prioritize transparency in all aspects of their financial decisions. No transparency. Mutual funds lack transparency when it comes to financial information. They are not required to provide investors with accurate information about expenses, which can make it difficult to make informed investment decisions. As such, investing in a fund that does not disclose its expenses could potentially be a risky move. Being unaware of potential costs associated with an investment is more than just inexperience. It is a willful ignorance. Invest for the long term. Because mutual fund investors cannot see the true numbers, they cannot see how much money the mutual fund company is taking from them. When a financial advisor recommends you invest for the long term, this is the reason why. Over more than 40 years. Mutual fund company. 80% of the returns, 20% of the returns, 0% of the risk, 100% of the risk, 0% of the capital, 100% of the capital. The mutual fund company receives 80% of the returns because the mutual fund company is always collecting fees over the life of the relationship between the fund and investors. The investor takes 100% of the risk and puts up 100% of the capital. It's clear why banks don't extend loans to purchase mutual funds and insurance companies don't cover potential losses. Not all investments are created equal, and leaders or teachers have the responsibility of helping people recognize the difference between them. Unfortunately, due to the lack of financial education in the school system, many people, even those who are highly educated, are unable to differentiate between the varying types of investments and identify which ones are more beneficial. Now that you have seen the differences between real estate and mutual funds, you should be better able to decide which investment is best for you. Investment